I spent £3,078 on a new MacBook Pro, a new camera, and loads of other equipment through my business. And in this video, I'm going to be talking through the best way to buy equipment like this through your company and the two different approaches you can take when doing it. So as I mentioned, I spent a grand total of just over £3,000. The highlight was a brand new MacBook Pro. My old 2013 one of 9 years needed an upgrade, so I got the 2021 MacBook Pro 14-inch. I got a brand new Canon N50 Mark II camera, which is what you're watching this on. I got a new ring light, microphone stand, some other equipment and cables and random bits and pieces, but it came to £3,078, 72p. Now for me personally, this was a huge investment into all of this equipment. It's the most I've ever sort of invested into the business, but there are ways that you can benefit you, and that is one good thing of being a business owner and having your own business. You can buy things like this and then put it through your accounts in the way that favors you the most or has the most advantages for your personal situation. Knowledge. And there are two main approaches you can take when it comes to buying equipment for a company. You can either expense it or capitalize it, and we're going to go through those two approaches now: the accounting impact, the tax impact. Then we're also going to touch on the final bit, which is probably the most interesting, the Superdeduction. And then I'm also going to touch on what my accountant said about this very briefly, because I also chatted to them about this before I decided the treatment and the path I wanted to go down. The first approach then is to expense this equipment. What this essentially means is, from an accounting point of view, if you're interested in that, you debit your expense and you credit cash. What that means in normal terms, you essentially increase your expenses, you reduce your cash, and you put it through your profit and loss as an expense, which essentially means you increase your expenses, which will reduce your profit, and you decrease your cash because you need cash to pay for all of this. The tax side is a bit similar. As I mentioned, you put it through the profit and loss account or your P&L, and when it comes to your taxable profits and what you pay tax on, it's revenue minus costs equals taxable profits. So of course, as your costs go up, your taxable profits will come down, and you essentially pay corporation tax on a lower taxable profit number. For me, that'd be 19% corporation tax. A big misconception is that people think if you buy all of this equipment, you don't need to pay money for it, and it's just a win-win. You do need actual cash to buy all of this stuff, and you don't save on 100% of the cost, but you do save on the tax impact. So this new MacBook Pro 2021 14-inch cost me just over £2,000. For simplicity, we'll just say it cost £2,000. I'm not gonna save £2,000. I still had to pay £2,000 in cash from my business account to pay for this, but what I am gonna save on, should I expense it, is 19% corporation tax. So just say my revenue was £10,000. I pay corporation tax at 19%. That means I'd pay £1,900 at the end of the year. However, now my revenue is still £10,000, but I buy a MacBook for £2,000. My taxable profit now reduces to £8,000, and 19% corporation tax on £8,000 is £1,520. So by buying the MacBook through the company, I've saved 19%. That difference between what we had originally of £1,900 and now £1,520, that's essentially the tax that I've saved by buying this through the company and expensing it. I don't save on the whole £2,000 that I bought the new laptop with, only the tax that I would have paid had I not bought it. So you just save on the tax. And that's something of a misconception. People think when you buy stuff for a company, you still need the cash to pay for it all, or if you buy it on a credit card, you need some sort of cash or credit line to buy it all, but you just save on the tax impact of it. The second approach then is to capitalize these assets, capitalize the equipment. So once again, the very fun accounting side would be to debit asset, credit cash. In layman's terms, that essentially means you increase your assets and you reduce your cash, because once again, you need cash to actually pay for all of this. Obviously. That would be then held as an asset on your balance sheet, and you depreciate it each year. That depreciation would then go through your profit and loss over some sort of useful life. Technology generally has quite a short useful life, but you'd have to work out what the useful life would be. You then depreciate it each year, and that's the accounting side of things. From a tax side of things, it's very similar. Once again, we have revenue minus costs give taxable profits, and this would go through as a cost to increase your cost, reduce your taxable profit, and you once again save on the tax impact of buying all these items. So for me, it'd be 19%. But this is where it gets interesting. But wait! There's more! Because currently there is a new scheme running which came into play in April 2021, and is the Superdeduction. During COVID, the government introduced this to essentially motivate or inspire people, don't know what the right word is, to get people essentially to invest and spend money to try and boost the economy. And one way they did this was by introducing this super deduction where if you capitalize an asset, like a MacBook Pro, for example, that I bought, then you can actually reduce 130% of its value as a cost to reduce your taxable profits even more.
Hey, that's pretty good.
So let's go through an example. It's the same as capitalising it like we've done in the previous example, but rather than reducing it £2,000, I can reduce £2,000 times 130%. So you essentially get an extra 30% reduction to then pay even less tax.
Boom.
The £2,000 times 130% is £2,600. So that means when I'm coming to working out my taxable profit for buying this MacBook, I can reduce £2,600 from my taxable profit. So going back to that previous example again, if I have £10,000 in revenue, my cost is now £2,600 from buying this 2000 MacBook Pro, so I'm getting a 130% reduction. That then gives me a profit, a taxable profit of £7,400, which if I then pay corporation tax at 19%, I then pay just over £1,400. So I essentially save another £120 on tax I would have paid because I'm utilising this super deduction. I believe this scheme runs until 2023, but if you're able to buy equipment for a company, capitalise it, and use this super deduction, you can get 130% allowance, which will reduce your taxable profit even further to pay even less tax and review your corporation tax bill a bit more, which is obviously a benefit, more money in your own pocket. So I spoke to my accountant and all of this, I talked through it with them, but essentially their approach with my stuff personally anyway, is that they're not going to capitalise anything less than £150 just because it probably won't be used for that long in the business, it'll probably break or need replacing. But things such as this £2,000 MacBook Pro, this Canon N50 camera that I got, which the whole package was over £700. They said it's wise to use the super deduction on these things because I'm going to use them for many, many years in the business. I mean, my last MacBook Pro lasts 9 years. Hopefully this one lasts the same. The camera hopefully will last years and years, which means in this financial year for 2022, I can reduce 130% of the value of these two bits of equipment, which roughly speaking, I would have been able to reduce £2,800 roughly, but now by utilising this super deduction and getting an extra 30%, I can reduce my taxable profits by £3,640, which then means I'm essentially going to pay less tax in the end because I've got a lower taxable profit.
You like that? You like that?
Of course, as I was saying again, I did need the cash to buy all of this. I did need the £2,800 to buy the MacBook and to buy the new camera, but when it comes to actually paying my tax, I can reduce more than that to then pay less tax at the end of the financial year. And that is it for this video. I got a lot of comments asking me how this all works, whether we should expense items or capitalize items, and that was only when someone messaged me on Instagram about the super deduction. I wasn't aware of it before, which is the great thing about social media. I then spoke to my accountant, they talked me through it, and now here I am making this video. So I'm gonna use these bits of equipment, the large bits, I'll be super deducting them to reduce my taxable profits by 130%. The more smaller bits of equipment, like the £30 ring light, £30 microphone stand, some little cables and other bits of gear I got, I'm just gonna expense because they're cheap, probably gonna break, and they're not worth capitalizing. That's the approach I'm gonna take. Of course, all this sort of accounting and tax stuff is subjective. It may change based on your opinion or based on the accountant you're working with. So whatever you're gonna do, let me know in the comments below. I'm always interested to learn more and find out more. But thank you very much for watching, and I'll see you in the next video.